Hey everyone, and welcome back. Today, we're diving deep into something that affects your money, your local businesses, and even the future of our economy: the incredible differences between the banking systems in the US and Canada. You might think all banks are pretty much the same, right? Think again. What if I told you that in America, our banking industry is shrinking, local banks are vanishing, and a handful of giant institutions are gobbling up everything? And what if I told you that our neighbor to the north has a system so stable it's been called the soundest in the world, with zero bank failures in over 2 decades? Stick around, because this story is more than just numbers. It's about innovation, competition, and what it all means for you. Let's kick things off by looking at our own backyard. Here in the US, our banking industry is undergoing a massive transformation. We're actually seeing a huge decline in community banks. Right after the financial crisis, we had about 7,000 community banks. Now, we're down to roughly 4,000. That's a significant drop. These local banks are truly struggling to compete with the biggest players out there. And why is that? Well, it's because the largest banks are often seen as being too big to fail. This means if they get into trouble, the public might end up subsidizing them, giving them a distinct advantage. Think about it. The four biggest banks in the US, JP Morgan Chase, Wells Fargo, Bank of America, and Citigroup, now hold an increasingly massive chunk of the nation's banking assets. This idea that regulators are more likely to let a small bank fail than a big one actually encourages banks to get bigger and bigger, to merge, to consolidate. It's a powerful incentive. Now, despite this consolidation, we still have a whopping 4,500 banks in the US. That's a huge number, even when you compare us to other economically developed countries, and even when you factor in our population size. But here's where it gets really interesting. Just across the border, Canada has a mere 79 banks. It's a stark contrast, right? Our banking system used to be incredibly diverse. If you go back to 2005, just about 20 years ago, we had around 7,500 banks. Go back further to 1975, and that number was about 14,000. And believe it or not, in 1921, there are over 30,000 commercial banks operating in the US. This was largely due to old state laws that limited how many branches a bank could open and made it illegal for banks to cross state lines. But these rules started to change in the 90s, and that's when the consolidation really took off like gangbusters. Many of the megabanks we see today are the result of these massive merger sprees, essentially swallowing up regional and community banks. This trend could continue, especially if policies ease capital requirements for these giants, making it even easier for them to grow. Plus, there are high fixed costs in banking, like new regulations or setting up a crypto department. Bigger banks can spread these costs over more customers, pushing them to get even larger. Now, let's talk about Canada. Their concentrated banking system has some serious advantages, particularly when it comes to stability. In fact, during the 2008 financial crisis, the World Economic Forum declared the Canadian banking system the soundest in the world. And get this, Canada has never had a banking crisis. Not one. Hats off to them. They really do a lot of things right. Their regulatory culture is strong, and their system is built differently. The banks there are incredibly concentrated. We're talking about their big six banks, which collectively hold an astounding 93% of Canada's deposits. Some people even call it an oligopoly. But this concentration comes with a major benefit. Larger banks are less likely to fail because they have a more diversified base of depositors. They've always had more conservative lending standards. This played a huge role in 2008. When we were grappling with a subprime mortgage crisis, a foreclosure crisis, and a housing market collapse, Canada experienced none of it. People's retirement savings were safe and sound. The Canadian banks take less risk than our banks do, partly because of how they're regulated. They have one powerful federal regulator, the Office of the Superintendent of Financial Institutions, which oversees everything nationwide. Compare that to the US, where we have at least three different federal regulators: the OCC, the Federal Reserve System, and the FDIC, each with their own focus. This regulatory complexity in the US actually leaves room for innovation. allowing new banking ideas to get started on a smaller scale, maybe as a state bank, and then grow if they prove successful. But back to Canada's stability. Since 2001, Canada has had zero bank failures. Zero. In the same period, we've had 570 bank failures in the US, including the high profile collapse of Silicon Valley Bank in March of 2023. When depositors got nervous about Silicon Valley Bank, where do you think they headed? Straight to the nation's largest banks. Even if their deposits might not have been uninsured there, they knew those banks were simply too big to fail, meaning they'd be protected no matter what. Interestingly, part of the reason Canadian banks have done so well is because many of them have significant operations right here in the US. They can take more risks and make more money in our market. By 2023, nearly half of everything these Canadian Big Six banks owned and owed was foreign offshore, and about 80% of that was American. They're playing in spaces that are far more volatile and less regulated than what they do back home. But let's be clear, if a Canadian bank were to fail because of some of these higher risk bets they're making outside their borders, it would be absolutely disastrous for the Canadian economy. The too big to fail phenomenon applies to them too. The bigger the bank, the more economic and political damage its failure would cause, making it unacceptable to let it go down. So, would the US benefit from a consolidated system like Canada's? It's a complex question. While Canada's stability is enviable, their concentrated system also comes with potential downsides. A system with so few players, essentially an oligopoly, can limit competition and innovation. If you're a small business in Canada, it can be harder to get the kind of lending you need when you're just starting out compared to the US. This could mean less employment, less innovation, and slower economic growth overall. In fact, Canada's economy has lagged behind the US economy for years, and their entire GDP is comparable to just New York State's. When a few powerful players dominate a market, they can control the industry. Canadian banks, for example, can charge more for service fees, and they do. There's even evidence that they actively keep competitors out. Apparently, no new big bank has ever emerged in Canada since the country was founded. Their culture and mindset are more prescriptive and controlling of banks' decision making. Here in the US, we generally encourage innovation and allow for a bit more risk within parameters, balancing it with stronger capital requirements. The US has always prided itself on having one of the most diverse banking systems in the world. Community banks make up about 90% of all insured institutions here. They've long given people with a great business idea a local place to go for a loan. In fact, small banks account for a huge share of small business lending. About 29% of small businesses seeking loans, lines of credit, or cash advances go to small banks. These community banks do a very, very large percentage of all small business lending. And this is crucial because small businesses are the driving force behind job creation in the US. If we weaken our community banks, we restrict a key source of credit for our smallest businesses and put a damper on economic growth. Think about it. Market domination is rarely a good thing. You lose competitive pricing, you lose innovation, and you lose that competitive spirit when a few giants control everything. The Supreme Court actually warned about this decades ago, saying that when banks get bigger and bigger, it can push the rest of the economy to consolidate as well. That's why we value a very diverse banking system with banks of all sizes. So, what's the right number of banks for the US? There's no fixed answer. Just like in any other industry, the ideal number of businesses fluctuates over time, driven by supply and demand, periods of growth, and periods of consolidation. We need to make sure that our local banks don't go extinct if we truly care about economic growth across the country. It's not an either-or choice between our decentralized system and Canada's concentrated one. Maybe a concentrated sector could even benefit from being a little less concentrated, finding a balance that offers stability without sacrificing innovation and competition. We definitely shouldn't shrink down to just 3 national banks, even if it might seem safer from a purely regulatory perspective. The cost to consumers and small businesses would be immense. Ultimately, we have to carefully consider the trade-offs. The US banking system allows for incredible innovation and supports the engine of small business growth, but it comes with higher risk and more failures. Canada's system offers extreme stability and security, but potentially at the cost of less competition and slower innovation. It's a fascinating balancing act that directly impacts all of us. Thanks for watching, everyone. If you found this discussion insightful, please hit that like button, subscribe for more deep dives into the world of finance, and don't forget to ring that notification bell so you never miss an update. See you next time.